Good afternoon, everyone. I am Bonnie Sussman, partner in the Financial Services Group at Eisner Amber. I am pleased to introduce today's panel, Private Equity Beyond COVID-19, Disruption, Innovation, and Cultivating Evolution. Our panel of top private equity professionals will discuss how changes brought upon COVID-19 have forced the industry to quickly innovate and adopt new practices. If you would like to submit questions to the speakers, please use the Q&A widget, which will also direct you to the live tech support.
Good afternoon, and thank you for joining us at our summit today. We'd like to welcome all of you today to a panel discussion of private equity during and post-COVID world. My name is Paul Goldberg, and I cover alternative asset managers for Bloomberg Intelligence. Today, I'm joined by a diverse group of industry leaders. Susan Gates, partner at Leeds Equity Partners, John Frankel, partner at FF Venture Capital, and Arthur Peponis, head of private equity at Angelo Gordon. With that, let me look at the immediate challenges that the industry faced. And one of the biggest challenges, obviously, with everybody being locked down for the past 6 months was the fundraising. The industry fundraising volume by number of funds closed dropped by half in the second quarter, by volume by a quarter. So with that, the question to the panel, how are your fundraising process have been impacted and how have you adapted? So Susan, let me turn back to you with that.
Sure, Paul. Happy to talk about that. My colleagues at Leeds Equity Partners on the buyout side were in market pre-COVID, raising their Fund 7 for their middle market buyout strategy focused on knowledge industries, and have continued and managed their fundraising process very effectively. It's been very efficient and effective, and really operating in very much the same way, just operating virtually in meetings with folks, and have continued along very successfully. On the Leeds Illuminate side, our new growth equity strategy, which I'm leading along with my partner, Elizabeth Cho, while we're not formally launched our process, we had a deal opportunity during the pandemic, and raised money for that opportunity. Announced the closing of that first investment for our Leeds Illuminate strategy several weeks ago. And we're focused on investing in education and workforce development, impact focus specifically, and announced our first investment in Eruditus, co-leading their $113 million Series D round. And we were able to effectively raise money for that opportunity during the pandemic. So, being deeply immersed in the sector and having strong relationships and the depth of experience with the companies in the sector, I think makes it continue to be effective and efficient to raise capital, just meeting with people virtually.
John, maybe you can chime in a little bit on the venture capital side.
It is absolutely the case across venture capital that fundraising for funds has been impacted, much less so than for deploying capital. And the reason for this is that a lot of venture capital fundraising requires in-person meetings, particularly with new people. What we found with existing LPs is, particularly in April and May timeframe, they were on pause. They were trying to work out which direction is up and how to take it from here. I think the best way to understand the impact of COVID and the economic fallout on the economy, on fundraising and generally, is it's not about averages, it's about the dispersion. And I think that generally, on average, things are fine. On average, our companies have raised the same amount of money year to date that they raised last year. but the dispersion is different.
John, thank you very much for that information, for your input. Let's move on to another question. Let's look at the portfolio companies. In April, at the very onset of the pandemic and for the lockdowns, Preqin conducted a survey with 62% of the managers noting a negative impact on their companies. So from a portfolio company perspective, how are these operations and liquidity initially impacted? And are things improving at this stage?
That is a really interesting question. One of the things that we track is revenue growth year over year of our portfolio companies, and we track it every quarter. And we noticed in Q1, revenue growth was about 34% year over year, which for a large portfolio, average revenue growth is pretty decent. Our expectation for Q2 was for the number to be single digit. It came in at 30%. And 30% is just not bad, irrespective of the fact of the deep contraction within the economy. What we noticed, of course, is that that was the average. We had a couple of companies where revenues went to zero, and we had a couple of other companies who did a full year's worth of revenue in that quarter because we invest in technology companies, and COVID has been an accelerant for tech adoption. We've seen this across the whole economy. What we're noticing into Q3 is the companies that were hit over the head by a 4x2, the ones that were really badly impacted, they're now finding their businesses bouncing back quite strongly. And the ones who saw the acceleration are seeing it continue. And, time and again, the conversations with our CEOs are that things are trending above expectation. So within the tech economy, it looks like you're going to see a strong rebound. Now, clearly not if you're a company that sells into hotels and restaurants. That will take a little longer. But fundamentally, it's been an accelerant. Our portfolio companies have held up well. The general sense across venture capital, when I talk to other GPs, is wide dispersion, but good averages.
So Angelo Gordon, we invest in consumer businesses and financial service companies. And on the consumer side, a lot of brick and mortar. So we actually own a number of restaurant companies. And then on the financial services side, we have some service companies which are capital light. And then we actually have some financial service companies which provide capital to small and medium-sized businesses. So from our perspective, we had tremendous disparity in terms of the effect of COVID on our portfolio. And for example, with restaurants, Benihana is one of our most notable investments. We found ourselves at the end of March having to close all 90 units within a period of days. And then in one of our lenders, which goes to small and medium-sized lenders, we decided to shut down funding down 85%. And so the reason for this is we recognized that we needed to take decisive action. And in situations like this where you're worried that your revenues are going to go down to zero, obviously liquidity is paramount to success and survival. And interestingly, what we did find is that the decisive action really truly did help us out. We found that the economy actually was more resilient than we thought. So for example, on the restaurant side, where you would have said that revenues would have gone to zero, in point of fact, takeout business more than tripled, quadrupled, and that was very beneficial to us. What we also found in the economy is that small and medium-sized entities that we provided money to, they were really truly resilient. We've also found that our lenders in general were very accommodating, and so I guess what I would say is that while we certainly wish it could be a bit better, it's a heck of a lot better than the downside. And in particular, on the restaurant side, we're actually seeing that our comp store sales are equal to what they were last year for those units that are actually open. reopened. So again, I think resiliency in the economy is something that maybe was a bit surprising for us and good news.
Switching on to the transaction activity, obviously, again, with things being on the lockdown, it's much harder to execute. M&A activity dropped dramatically in the second quarter, but it seems to be coming back at a very material clip. So the question for the panel is, how was the investment process changed due to the disruption? How was the traditional due diligence conducted? And what are the investment opportunities you found in this environment? Susan, let me start with you, but I think we can go to everyone with this question.
Sure, Paul. I think in many ways the investment process doesn't change. It's the method or the venue for carrying it out. And so for our recent investment in Eruditus, we have the benefit of being industry specialists and focusing on the knowledge industries, education, workforce development. And by focusing in one industry, in many cases, you are working with folks that you've known for some time. The CEO of Eruditus I've known for over 2 years. And so working through the diligence process and the negotiation process around this investment, the processes were the same. We were still meeting with the senior management team, meeting with the broader team, spending time talking to their partner institutions, doing technology diligence, doing reference checks. But the venue for those processes was different. Instead of consolidated time meetings at their offices in Mumbai or Boston or San Francisco, we were doing those meetings via Zoom to really deepen our understanding and follow up on all of the questions that we had and understand the business. But the processes, I would say, were very much the same, just elongated by having more independent meetings as opposed to consolidating those into several visits on site.
Art, you have a large investment portfolio at Angelo Gordon. How was the impact on the investing for you?
Yeah, I would concur with prior comments in terms of just the investment process. I think that because we also are specialists. However, there have been different effects that COVID and the resulting economy has had on those industries, and I think as a result of that, we look in terms of structuring maybe a little bit differently. So, for example, those where we're still concerned in terms of the effects of COVID on the operating performance. It may be more of a structured deal where there's downside protection, and in other circumstances where it may be more capital light, more service orientation, then that could be the more traditional equity type investment.
Now, John, you run a tech-focused venture shop, so anything in that area on the investment side, obviously this has been one of the industries that performed really well during the COVID and actually attracted some of the business.
Yeah, I've been around for quite a few recessions. What's happened this time around that I've never seen before is that tech has been accelerated because of the impact of COVID. We didn't see it in '87, we didn't see it in recessions in the '90s or in the noughties, but this time very much is different, which obviously are the four lie words within investing. The other thing to really note is the economy was strong coming into this. This was not a natural recession. This was a strong economy interrupted. And that's why I think we're seeing a strong rebound as well. Within tech has infused itself over the last 20 years in particular into a lot of other parts of the economy and has co-opted them. So we talk about e-commerce rather than commerce, and we consider e-commerce to be tech and commerce not to be. But I think in reality, it's a hybrid. And I think in reality, the companies that sort of sat across both sides of that hybrid really just accelerated their adoption. Just like restaurants accelerated the amount of takeout that they might do. We've seen particular examples of companies that have had considerable acceleration in what they do. An example would be a company we invest in out of Ireland called Manna, which is a drone delivery company. And they moved from project status to production status, which we didn't think would happen until 2022, over a matter of 3 months. The regulators moved very fast, and they now have a distribution deal in Ireland with Tesco, which is going live this quarter, something we really did not anticipate happening that fast. And we've got many examples across the portfolio of this, but it really has changed adoption. The other thing to understand is, tech adoption is really about behavioral change, about what people are willing to accept and do. And that usually takes time. But again, we've had a massive change in human behavior. And that is something that we think not only accelerates some of our existing companies, but is creating real opportunities amongst new companies that have just got started or being ideated right now.
So another question that I think can go well for everyone on the panel, and I think it's very interesting. So at the onset of the pandemic in April, some of the industry surveys we looked at the portfolio managers, fund managers, most of them expected about over 60% expected for the markets to come right back to normal within 6 months. Obviously, we are not at a normal level yet. So the question is, how do you operate portfolio companies going forward? What are the strategic operating changes you need? What do you envision for running the business? Art, let me start with you.
I think it's a great question. At the outset, when we were trying to predict, and really it was certainly unpredictable, it still is in terms of the impact of the virus and the duration, we want to actually have what we hope to be as conservative in terms of the timing, namely that the impact was going to last at least a year. And what I would say in terms of broadly speaking on how we're looking at managing and operating the businesses, what we're doing is, first of all, we're very engaged with all of our portfolio companies. But what we also are noticing is that we are forecasting and reforecasting on a much more frequent basis than we were before COVID. And during the throes of March and April, the reforecasting candidly could have been every couple of weeks as we were learning more and more. What we have noticed is that we've never gotten it right. Sometimes we saw situations where we thought the impact was going to be less. In some cases, we saw that it was actually more. And so the way that we are looking at operating the portfolio companies right now is making sure that we're very nimble in terms of our operations, our staffing, and depending in terms of where you sit, where the industry is, we may be in a position of a wait and see. And making sure that, again, that we are nimble such that when we do have some degree of normalcy, whatever that looks like, that we will be properly positioned, properly staffed with the operations to go forward to have continued success. But again, reiterating some of the earlier comments, I've been pleasantly surprised in terms of the strength of the economy for those companies that we own.
In the education and workforce development sector, this has been a growth area pre-pandemic, and in many ways across many parts of our sector, the pandemic has accelerated opportunities. So from the standpoint of thinking about how we support our portfolio companies, I would agree with Art that part of it is planning for continued disruption for our companies that are normally site-based or in person, and plan for continued support of virtual delivery of services. But also really thinking about where can we invest to support the growth that we're seeing as opportunity from the acceleration of demand for companies that are providing upskilling and reskilling opportunities, that are providing virtual learning environments in a high quality way, or that are providing support for an underlying need that was already there that will persist, but may be a more acutely felt need as a result of the pandemic. One of the things that the last 6 months has really exposed for folks is tremendous inequity in access to quality education, and the opportunities that provides to really support solutions around their areas for continued investment.
John, can you add on your end, what are the challenges, opportunities within the industry for your companies?
It's really interesting. People like to see this as an economy that will come back at some point and be the same as the one before. I just don't think it will be. We have learned a lot during this period. We've seen people really re-examine how they want to live their lives and what they want to do. Our parallel is to go back 100 years, and we all know that there was a pandemic in 1918. It ran through to about 1920. It was followed by a pretty swift recession. The government didn't intervene, and the economy naturally healed. And then after that, we moved on to the Roaring '20s. My expectation when I talk to people who were not massively disadvantaged by the downturn in the economy, but sort of work from home and were in a position to be able to do so, once they can go on vacation, they're going to take a lot of vacation. They're going to go to a lot of restaurants. They're going to party. They're going to enjoy life. And I think that's going to happen across society. And so I think we're going to come into the Roaring '20s. I think from a work perspective, you're going to find that working remotely, which really is a natural outcome of something we talked about 20 years ago, the paperless office. When are we going to have a paperless office? Why do we need printers? We're in the paperless office now. And what we've realized is that it really is untethered. And so I think there'll be new ways of working. I think companies will definitely move to a hybrid model. Some will move to only being in the office 1 or 2 days a week. Others will go fully remote. But even for those that don't, I think there'll be a much better acceptance of someone saying, I'm going to work from Iceland for the next month. And people are allowing that to happen. So I think there's going to be just a change in the work environment generally. The need to travel from business perspective, I think, will change. And I think it will take a long time for business travel to recover, not because of economic reasons, but because of necessity reasons. That being said, human beings are social animals. The reason why you read these stories about college kids partying is because that's what people do. And unconstrained, I think there's going to be enormous bounce back in cruises, leisure travel, restaurants, entertainment generally.
Another aspect of the industry, obviously, the relationship with limited partners. Some of the surveys found that 2/3 of them were concerned during the pandemic that they were not getting enough information, that they were not getting enough portfolio company understanding. So during the crisis, how did your relationship change, improved, gotten tighter with the LPs? What are the investor relation challenges and opportunities you see from here? Art, if you can chime in on this.
I would say that the LP universe has been very understanding and accommodating in terms of the GPs and the challenges that candidly all of us are facing in terms of our strategy. And it's not unique by any means. I'm sure most, if not virtually all of the GPs are doing it, is that there just needs to be increased communication, maintenance of transparency, which we strive to do in all environments. But what that means is more frequent communication, whether it's conference calls with advisory boards or, frankly, one-on-one communication as well. And in those circumstances where there needs to be additional capital put in, or there needs to be discussions with lenders, providing the thesis in terms of why there is a need for additional capital, or the thesis in terms of how these businesses are going to thrive going forward. I think that has been very helpful when we have that dialogue with the LPs, where we let them in so that they understand in terms of how we're thinking about the long-term view and vision for these companies. But again, I found that the LP universe has been very understanding in terms of what the GPs are facing.
John, anything on your side?
I think what we're seeing is very, very similar. We've found increased engagement with ILPs, the ability for us to use Zoom. Not that we couldn't use Zoom before, but the general adoption of Zoom, I think, has been very beneficial with regard to communications. We have been able to do more frequent updates, particularly during the uncertain days of March, April, and May. It was very helpful, I think, to our LPs to connect them directly with our CEOs, to give them insights on what we were seeing and our companies were seeing within the economy. And I think that level of intimacy and communication that Zoom actually brings, I know people don't like to use the term intimacy in Zoom, but I think it is, in this situation, that's something that's going to continue. I think that in-person meetings are essential to establish relationships and to continue to build relationships, but I think they can be augmented. Just as we talk about hybrid work environments, I think there's going to be a hybrid communication approach that we're going to take going forward. I do not believe that we go back to the identical work environment we had before. I think it will be enhanced, and I think everyone will benefit from that.
So the big question on the investor's mind is, how do you invest? Is it a good time to invest at the moment? What are the opportunities? John, can you start on this?
As a deployer of capital, I always say it's a good time to invest, but I think it particularly is right now. We've had, 11 years upside in the public markets for what you would have expected to be a 5 or 6 year recovery from 08 and 09. If you think the next decade's returns in the public markets is going to be similar than the last decade, and there isn't a reversion to mean, then the public markets are a good place to explore tech. But within early stage venture, which is what we focus on, we think the secular opportunities are only expanding. And historically, whenever you have a big disruption and a recession that comes out of that, you have really great companies formed. So we expect the vintage years of 2020 to 2022 to be particularly rich. And it's on top of some really interesting tech stacks are being explored within fintech, within applied AI, which includes drones and robotics. These are all spaces we focus on. We expect to see great advance in the technology, and that leads to really interesting business solutions that are just going to be much more efficient than the alternatives out there. So we think it's a great time to be deploying capital. We think the returns will be high, And the advantage, obviously, of early stage venture is the returns are alpha, not beta, and so will not be correlated, when the next recession comes, if the Fed ever allows one.
Just following up on what John was saying, I agree wholeheartedly with him. And I think when you look in terms of the buyout space historically, in past recessions and investing in those recessions, those have generally turned out to be very, very good returns and very interesting years. And even though we invest in much later stage growth companies, but still growth nonetheless, we would concur with what John was saying. And in particular, for us on the financial services side, agree wholeheartedly on fintech and believe that there will be an increase in non-bank solutions for companies, both on the retail and on the commercial side. As it relates to brick and mortar retail investing as well, we do think that over the next couple of years will be a very good time as well in terms of making selective opportunities and investments. And the reason why we say that is that conventional wisdom would have suggested that as it relates to restaurants was an overbuilt category over the past several years. And unfortunately, as a result of COVID, we do see, and you are seeing already, many restaurants that are going out of business. And so what will happen is that there will be a continuation in terms of a more rationalized fleet of restaurants across the country, as well as for retail brick and mortar units. And as such, that will be, we believe, a more benign competitive environment, resulting in some potentially great opportunities on the retail space. So we concur with John's thoughts as well on the next couple of years.
Susan, what are your thoughts on the investment opportunities ahead?
When John was talking earlier about not going back to the same world post-COVID in terms of work and the work environment, I agree wholeheartedly with that, and believe that is very much the same for not going back to the same world in terms of how we think about education at all stages, from early childhood through developing workforce, and the opportunities that we see are very much tech-enabled opportunities to deliver high-quality opportunities for across a broad range. I certainly, this has been a growth area, and again, we see continued acceleration. Believe this is a great time to be investing in the growth stage and in the more mature stage on the buyout side at Leeds Equity.
Let us take some of the questions from the audience from the chat. One of the questions, and I think John is best equipped to answer it, is what are the technology implications? What are the technology challenges and opportunities you're facing right now?
With regard to technology, it is really amazing how many pieces of the infrastructure have been built over the last 5, 10, 15 years that allowed us seamlessly to go remote. And it wasn't just us as a venture capital firm, but out of our 76 portfolio companies, all of them went remote. Now, some were remote before, a couple were hybrid, but most of them went into the office every day. And they're now trying to counter the fact that they're saving 5 to 15 hours per person not commuting, and they're getting a lot of work done through Zoom rather than through meetings. They're finding the overall environment between Zoom, Slack, Gmail, text messaging, mobile phones, all of these technologies have come together. They're really finding that they can work very efficiently remotely. What they're losing out on is training, happenstance, and meeting new people. And so I suspect a lot of companies will be moving, certainly technology companies will be moving to a hybrid model. Us as a firm, we're trying to work out what we should be doing and what is the best cadence of in-person versus virtual meetings and engagement. And it's an evolving story, and I think it'll be evolving for a lot of people. Anyone who knows the answer today is likely wrong.
So I think the last question to close would be a bit of a broader one, and it would go for everybody. What are your expectations for the industry over the next few years, medium term? Susan, can we start with you?
Sure, Paul. John said earlier that this is not a natural recession. This was a strong economy interrupted, which is certainly the case. But as we look at where we are now and what I think what most of us would expect to happen over the next year plus, with continued disruption to the idea of business as usual, the opportunities will be more uneven. The recovery will be more uneven, and the outlook across different industries, I think, will require a more nuanced view. And so, as I think about what does that mean for this industry, for the investing industry, I think it really emphasizes the importance of deep expertise and focus within sectors, because the nuanced understanding around where the opportunities are and where the pitfalls are over a very uneven and uncertain future, I think will rely more heavily on the depth of expertise. And so I would anticipate an emphasis on sector-specific focus versus more generalist focus in terms of investments.
Yeah, I completely agree with what Susan was saying, and I liked her perspective in terms of a nuanced approach. I think stepping back, when you look through the cycles, and I'm talking about private equity, where we are right now is in terms of dry powder, in terms of investable capital, we are at an all-time high for the industry. And typically what you see, and again, this was not a normal recession, but typically what you see happening is that deal volumes go down dramatically. And also multiples go down dramatically because there's just not as much deal activity. And that's sort of what we saw in the second quarter. I expect that you'll see deal volumes continue to be more moderate than in prior years, and that will also reflect itself in terms of multiples. But what I do think will happen is that over time, we will see the equilibrium coming back to where it was before, namely higher multiples. And so for those funds that are specific in terms of industries, have expertise, have discipline, I think, again, following up on what my fellow panelists have been saying, I think it's going to be a very good time to invest. But I do recognize also that there is the overhang of all the capital that will be chasing the deals. And that's why you have to be disciplined, because that capital needs to be deployed over the next handful of years.
I hate to be in violent agreement with my panelists, but I think that's very much the case. As I mentioned earlier, my sense is that the averages are going to be fine, but there's going to be wide dispersion. Same within the economy. The energy economy is going to take longer to recover. The restaurant economy is going to take longer to recover, but they will recover over time. The tech economy and the finance economy feel to be, in good shape even now. So I think that's what we're seeing. Within finance, within investing, I think there's going to be a lot of opportunities to invest. We are a little bit through the looking glass with 0 to negative interest rates across the board. How that plays out, no one knows. The expectation is it gets really ugly at some point. but I think we've been saying that for about a decade. So, at some point in the interim, life goes on and investments are being made. We're seeing, real transformation across the economy at an accelerated pace. We're seeing this driven by tech and by advances across all fields. I don't expect that to slow down. And I think 2030 is going to look more different to 2020 as 2020 has looked to 2010. So I think it's going to be a wild ride. I think there's going to be a lot of opportunities. It's going to be volatile, and the dispersion is going to be pretty wide.
With that, I would like to thank everybody attending today's panel and our panelists, Susan, Art, and John. And I just want to echo some of the things that John just mentioned at the end. With life going on, with the opportunities being abundant, and the industry should be doing well a few years out.
We hope you enjoyed this panel session. The videos of the concurrent sessions will be made available after the event. Please visit the Summit Portal lobby to take our brief industry questionnaire for a chance to win an iPad Pro. At 2:30, please be sure to visit the main stage and click to launch the live fireside chat hosted by our CEO, Charles Weinstein, with Donna Brazil and Karen Hughes. Thank you.